Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, welcoming you to another FastGraphs Value Academy video covering Section 4, Part 2, the balance sheet. You can find our workbook that lists all the sections of this curriculum on the website www.fastgraphs.com and go up into the Learning Center, and then there's Value Academy information there, including the complete detailed workbook. Today I'm going to let Bill K. finish his discussion of Part 4. He covered the income statement in Part 1. Now he's going to be covering the balance sheet in Part 2. And then finally he'll be covering the statement of returned earnings and the cash flow statement in Part 3. So without further ado, let me turn it over to Bill K.
This is a continuation of Topic 4, Basic Accounting Concepts. We're going to review the income statement from the last video and then continue with the balance sheet. The balance sheet is a very important financial statement. It shows the financial health of a company or a family on one day. What do you own? What do you owe? What's the difference? The difference is a very important thing. Your net worth, your equity, the book value of a company. The balance sheet is called the book in certain cases. So we're also going to talk about a very important concept of capitalizing versus expensing an item. If you're buying a major item that's going to last over a year, you can capitalize it. Most financial people want you to capitalize it, spread the cost. Rather than taking the cost in the period it happened, we want to spread the cost against sales that hopefully it's going to generate into the future years. Assets, things we own. We're going to learn that the assets on the balance sheet are valued at an accounting value, not market value. That's a very important thing to understand. Liabilities, something you owe on one day that you haven't paid yet. If you've got costs and expenses that have been paid, they will not be liabilities. Liabilities are just things you are going to owe in the next year or in future years. In a lot of cases, we call current liabilities payables, wages payables, notes payable, interest payable, tax payable, and so forth. Accrued liabilities, things you owe you haven't paid. Long-term debt is a liability, but it's not due this year, it's due in future years. The principal on the money you have borrowed. So the difference between what we own and what we owe in GAAP accounting, accrual-based accounting, is if it's a public company, stockholders' equity. In our personal lives, it's our net worth. So we're going to look at the typical balance sheet format, how it's laid out. The balance sheet, we'll be covering it in just a second, but let's do a quick review from the last video on the income statement. It always starts with the income statement, those temporary accounts that roll back to zero and start at zero at the beginning of a new fiscal year. Sales revenue, matching cost and expenses, and the different profit or loss in accrual-based accounting. That's where it starts. Now, the balance sheet and the income statement are both done in accrual. That's GAAP accounting. Since we really don't know a lot about cash other than the cash on the balance sheet at one day when we do the balance sheet, in 1988, FASB, the Financial Accounting Standards Board, decided that all public companies must show us a cash flow statement. This statement only looks at one key account, the cash account, and it takes accrual back to cash. And I say the most important number in business is cash flow generated from a company's operations. It's always about cash flow. If a company is generating positive cash flow more than their accrual profits, that's a good thing. They're keeping their working capital accounts under control. Their accounts receivable, you want to bill it, collect it. their inventory. You want lean just-in-time inventory. You don't want a lot of inventory sitting there using up your cash. And accounts payable, you've got to pay your vendors and suppliers, but you really don't want to do that until you have to. You want to keep your cash as long as possible, the time value of money. All right, let's go back and just look at a income statement, a statement of earnings. Let's say Microsoft at the end of their fiscal year, into June 2021. For the last 12 months, they generated $168 billion, 88 million, rounded to the nearest million, we're dropping 6 zeros, of revenue. Quantity times price. This is net revenue after any returns, discounts, or allowances. This is money they expect to receive from their customers. Now we match to that in accrual all the cost to generate that revenue. The difference between our revenue and our total cost is our gross profit. So you take the 168 billion minus the 52.2 billion and you got 115.8 billion left. That is a very important number. We're going to turn this into a percentage in just a minute and look at their gross margin. Now, the cost to generate that revenue, that could be direct labor, direct material, direct overhead. Those are the people making the software and other things for Microsoft. Maybe making the Surface, their computer, and so forth and so on. They've got a lot of revenue from products and services. All right, they've got some other operating expenses. They've got a lot of facilities around the world with a lot of people and so forth and so on. They've got finance, they got accounting, they got IT, advertising, on and on. So during the last 12 months, they had 45.9 billion in operating expenses. Some of that might be R&D. R&D has to be expense. Some of it is SG&A, selling, general, administrative. A lot of operating expenses. So when we take the cost of the revenue and the operating expenses off, we have almost 69.9 billion left in operating income. Now this is known as EBIT, earnings before interest and taxes. And that's a very important line item that companies watch very close and the analysts watch. Now below this are the other things. Now Microsoft has a lot of free cash, so they invested stocks and bonds and other things, and they make some income off of it, other income. Net means after some things. So they had the bottom line other income net of 1.186 billion. That adds to what they're going to have to pay taxes on. So we're up to 71,102 income before taxes. They have a provision for taxes of 9.8 billion, leaving them the bottom line 61,271,000,000. That number in the oval is called their return for this fiscal year. For the 12 months ending June 30th, 2021, they had 61.3 rounded up billion in profit, net income, after all costs and expenses. Now we go to margins. This is something we figure in finance. The top line's $1 or 100%. So out of that dollar, what went out in cost? Well, 31.1 cents went to the cost of the revenue, leaving them with 68.9% in gross margin. Now the operating expenses ate another 27.3 cents of a dollar, leaving them with 41.6 cents as their operating margin. Excellent margins. You know, this is one of the reasons Microsoft is a AAA rated company. Great profitability and accrual. Now we brought in another 0.7 cents from other income. We're up to 42.3 cents of every dollar in income before taxes. Taxes eat another 5.8 cents of every dollar, leaving this a bottom line net margin. Look at that, 36.5%. For every dollar they sold, they got 36.5% left, an excellent net margin. So we're always watching our gross margin, operating margin, net margin. We always look at tax rate. So if I was to ask you the tax rate for Microsoft in this fiscal year, you divide 9831 by 71102, and for every dollar of income before income tax, they are paying out that 5.8%, or 13.8% is their tax rate. You know, the corporate tax rate for the United States is in the low 20s right now, and that's an excellent tax rate. They've got some smart tax accountants that legally use a lot of tax loopholes and other things, loss carry forward, accelerated depreciation, and so forth, to keep their taxes down legally. All right. The next thing we do is we take that return, that bottom line of the $61,271,000,000, divided by the weighted average common shares outstanding during the year. So we look at basic shares first, and they had 7,549,000,000 basic shares outstanding during the year. That's a weighted average during the 12 months. You divide that into the 61,271, and a statistic, a very important statistic. The basic earnings per share is $8.12. Now, Microsoft has some stock options outstanding. When we include those, it's called diluted. It increases the number of shares from 7,547 up to 7,608. When you divide that number into the 61,271, the diluted earnings per share drop down to 805. GAAP requires we show this at the bottom of the income statement. So it starts with the income statement, the profitability of a company in accrual-based accounting, GAAP accounting, over a period of time. This happens to be 12 months fiscal year. Top line, bottom line. We always look at margins, earnings per share. And earnings per share we want to see go up, and that definitely helps drive stock prices. Right now, Microsoft's stock price is at a very high number. It is considered overvalued, but it's a great company. Great sales, great profits, great margins. All right, now let's move to the balance sheet. This is the final output of financial statements. We always start with an income statement. As we'll see moving forward, we look at the retained earnings, the change in that, the money put back in the business, that's in the equity, the cash flow, and the cash flow, you need those things to get the balance sheet. So now let's look at the balance sheet in accrual-based accounting. We know the income statement basically is the operations of a business, and we just looked at that. Sales minus cost equals gross profit minus operating expenses equals operating profit, and other things, income taxes, that's the bottom line. As we're going to see now, we're going to see what assets does the company have to generate those sales and profits in accrual. So we're going to go on to the balance sheet on one day. This is a snapshot of the financial health of a company on one day. What were their investments? This is a very important thing to know. What has a company invested in to generate those sales and profits? We'll look at their current assets. The definition of current assets is a liquid asset that could be turned into cash or used up within 12 months or 1 year. Those are things like cash, accounts receivable, inventory, prepaid. We'll look at their fixed hard tangible assets, computers, buildings, equipment, furniture. Those things can be put on the balance sheet at historic cost and depreciated over their life. That's capitalizing, as we're going to see. The other assets, the other intangibles, are very important in today's world. We're seeing a switch from fixed assets to intangible assets. 20 years ago, most companies had a lot of fixed assets. Still, certain industries do, like auto manufacturers and industrial companies. But with technology today, and we know so many companies that are doing so well, like Google and like Facebook or Meta or like Microsoft, they have a lot of intangible assets or other assets. These are assets you really can't touch, feel, or see. You can see them, but it's like software, patents, copyrights, goodwill. And these are things we can amortize. We depreciate fixed, we amortize others. So the balance sheet shows us, in accounting, total assets of a company on one day. So at the end of June 2021, we're going to look at Microsoft's total assets. So those are their investment in assets, according to accounting, to generate those sales and profits. Now, financing, how did they raise money to get these assets? Well, we look at debt and equity. And debt is referred to as liabilities. And liabilities is what we owe on one day. We got things from vendors and suppliers, accounts payable. We're going to have to pay them back. Those are called current liabilities. Anything we have to pay back in the next 12 months, we owe to people. We owe to different companies. All right. We might have borrowed some long-term debt from the big banks at low interest rates, and the principal amount is not due this year, but might be due in future years. If it was current, it would be up in current liabilities, the current maturity of long-term debt. But the amount of the principal due in future years is called long-term, longer than a year. So we'll look at the total liabilities. And the difference between assets and total liabilities is going to be equity, shareholders' equity. The shareholders' equity is a part of the assets the shareholders own. Part of the assets the creditors own is the liabilities. And we're going to see under shareholders' equity the amount of money Microsoft brought in when they sold stock, did an IPO, and the profits reinvested back in the business, the retained earnings. All right, so the magic formula of the balance sheet of accounting is your assets on one day always equal your liabilities plus your equity. We'll see that. Now remember, those net profits, or it could be a loss if it ever happens, the profits go back into retained earnings under equity, or if you had a loss, it would reduce retained. So this goes up and down since the business started. It's only a statistic, but it's a very important statistic, retained earnings, that makes the balance sheet balance. So we're always watching the investments of a company. What kind of return are we getting on assets? We're always looking at the margins and the profitability of a company. And then we're looking at debt to equity and the leverage the company is using to generate the sales and the profits. All right. Capitalizing versus expensing. If it's something under a certain amount, and this is a rule companies set up, they're going to take the expense in the period it happened. Let's say you spend $1,000 on some supplies. Well, we're not going to capitalize that. We're just going to probably expense it. Anything over a certain amount, maybe over $10,000, $15,000, $20,000, your accountants will say, anything over a ruled amount, we want to put it on the balance sheet and spread the cost against sales into the futures. That's capitalizing. All right. What a company owns their assets. What a company owes on one day, their liabilities. The difference, shareholders, stockholders, equity, is the money invested by the owners in the business plus the profits put back in since the business started. So this is the accounting equation, double entry accounting. anytime there's a transaction, two or more accounts are going to be affected, and in total, your total assets will equal total liabilities plus your total shareholders' equity. That always stays in balance. And this balance is found on what statement? On the balance sheet. That's why we call it a balance sheet. What I tell my students at the university is just remember ale. Think of Sam Adams drinking his ale. What you own on one day, what you owe on one day, and the difference. And assets have to equal liabilities plus equity. So this is the balance sheet, the equation of the balance sheet. All right, there we go. And in finance, we drill down. These are high-level account types, A, L, and E. Remember, the liabilities and equity are the sources of capital, sources of funds. The assets are the uses of funds or your resources, your investments. You got to put those investments to work. We like asset turnover, turning assets into sales. For every dollar of assets, we'd like to have a dollar of sales. We'll look at that for Microsoft. If you take A minus L, that's what's left over, value of the company on the balance sheet, the net worth of the company, the book value, what you own, what you owe, and the difference. Now, we talked about current assets, liquid assets. You could turn them into cash within a year or less or use them up. Current liabilities you're going to pay out in the next 12 months. And under equity, we look at money brought in through the sale of stock, either preferred or common, as contributed capital. You sell part of your assets to basically shareholders. They give you money and they own part of those assets. That's the equity amount. The fixed hard property and equipment, those are things you can depreciate, you can capitalize. The long-term debt, you're going to owe that, but not this year and future years. And yes, the important retained earnings, the profits put back in the business since you started. Very important statistic. Intangibles, patents, copyright, trademarks. Very important in today's world that you can amortize, and goodwill. When you pay more than equity amount for another business, you can capitalize that. But you can't amortize goodwill any longer. We look at that, and if it doesn't give us back sales, profits, and cash flow, if you invested in another company, you might have to take an impairment charge and bring it down. If you bring that down, then the equity comes down. All right. Retained earnings are the profits put back in the business. The only thing is that if you pay dividends, it'll come off before the retained earnings are put back. And that is true for Microsoft. They pay a dividend. So we're going to see that as we move forward. Resources, assets, what we own, sources of capital, liabilities plus equity. All right, that's the basic balance sheet on one day, financial health on one day. There's the equation. Now, the balance sheet gives us this detailed snapshot of the financial health of a company. And one of the things we look at is debt to equity. How much debt are they carrying to how much equity? We look at the liquidity. How much cash could they generate in the next year? Current assets to current liabilities. So that's a very important equation. But does the balance sheet show us whether a company is profitable? Are they making a profit or losing money? If you had 2 years, yes, you could tell. You would look at retained earnings. If it goes up, we're making a profit. If it goes down, we showed a loss this year, possibly. But if you only have 1 year, guess what? You have no idea if a company is profitable from the balance sheet. You really need to look at all the financial statements to understand a business and how they're doing. Income statement shows us profitability. So from a balance sheet 1 year, we do not know profitability. This is the job of the income statement. Now let's go to the actual Microsoft balance sheet And they're required to show us the last 2 years because we can see the retained earnings in. Plus, we can see the changes in all of these line items. It starts with our most liquid assets, current assets, cash, and cash equivalents. What could we turn into cash within 90 days or less? Maybe it's sitting in a money market fund or a treasury bill. We have some short-term investments. So Microsoft on June 30th, 2021, under assets, they showed total assets of $333,779 billion. A lot of assets, but these are accounting numbers other than the cash, basically. So that's a lot of assets, but it's not market value. It's accounting value, as we're going to see. So there's the total assets, and out of that, $130 billion is basically liquid cash. That's total cash, cash equivalents, and short-term investments. That's amazing. $130 billion sitting there in cash. And they're going to invest that. They invest that in short-term investments. Now, people owe them accounts receivable of $38 billion, and that's after an allowance for doubtful accounts, allowance for bad debts. They're taking off $751 million of money they just don't possibly think they might not receive. Certain customers might not pay their bills. And we get that from history. So that's a net amount of $38 billion we expect to receive. And you can see it went up from 32 last year to 38. Inventories. Those are things they're holding in inventory, and they got $2.6 billion. They've got some other current assets at 13.4. We want to know more about the details of that number. We'd look in the footnotes or the notes. Total current assets of $184 billion plus. So that's our current assets. Very important number in finance and accounting. Things we could turn into cash within 12 months or use up. Now the hard fixed property and equipment net of accumulated depreciation is $59 billion. It went up from 44 to 59, so we know they have added some property and equipment from last year to this year. They've got some operating leases, right of use assets. Those are things they're leasing, but at the end of the lease they're going to keep and they're capitalizing. They've got some equity investments in stocks and other companies. They got some goodwill. That's money they paid above book value when they bought other companies. And look at their intangible assets net after amortization. $7.8 billion. And some other long-term assets. Once again, we can look in the footnotes to find out more about that $15 billion equals the 333.8 rounded up billion in assets. So that's the assets of the equation. Now, capitalizing, those are things they put on the books at historic cost, and they have been bringing them down with depreciation and accumulating that depreciation. So to know about these numbers, you get into the footnotes. In Microsoft, it's footnote number 7. So let's look at that quickly. Note number 7. All right, you can see from note number 7 the historic cost of the hard fixed assets of property and equipment. They have actually spent $3.660 billion on land they own around the world. Buildings and improvement, almost $44 billion. Now, if you replace a roof, a heating system, air conditioning system, leasehold improvements, you can capitalize that, $6.8 billion. You can see, being a technology company, computer equipment and software, big one, $51 billion plus. And it went up $10 billion from last year to this year. And furniture and equipment around the world, $5.3 billion. So at historic cost, they basically paid $111 billion for those things. These are the details. They tell us the devil is in the details. So the details of the numbers on the balance sheet. 111 billion, and they have accumulated since they own that. Some of this has gotten older, and they're bringing it down. They're taking depreciation expense on the income statement, and they've accumulated 51 billion, bringing it down to a net value of, and that's exactly what we saw on the balance sheet. They showed us the net amount. Let's go back to the balance sheet 1 minute here and look at it. Remember this 59,715? Where did we get that number from? From the note right there. All right, they give you some details under that about depreciation expense. The devil is in the details. Now let's look at the other side of the balance sheet. Assets are the resources, the investments. Now, how did they get that money? The sources. Liabilities. We owe some money. In the next year, Microsoft has current liabilities of 88 billion. Those are dollars are going to have to pay out for accounts payable, current portion of that long-term debt due this year. Accrued compensation could be wages payable they owe to people, short-term income taxes, short-term unearned revenue. That's like monies they've received and they haven't given anything for yet, but they will in the next year. Then they got some long-term liabilities, long-term debt, long-term income taxes, long-term unearned revenue. That's like deferred revenue. We got money in, but we haven't given anything for it, so we have to set up a reserve. Deferred income taxes, operating lease liabilities, other long-term. So you add those together, and there's another 103 billion plus the 88 billion in current, and there's total liabilities of 191 billion 791 million. Lots of liabilities. Now the difference between the assets 333 and 191 has to be equity. And you can see the retained earnings is in equity. That has gone up from 34 billion to 57 billion. Those are profits put back in the business. So under equity, we look at the money we brought in from the IPO, common stock, paid in capital. And they show you the authorized shares and so forth. And we see those numbers, that 7519 is what we divided in to get our basic earnings per share. All right. The accumulated other comprehensive income, and this is income, a lot of that number is from currency exchanges, going from the dollar to other currencies. And that can be a plus or a minus. In this instance, it's a plus. And it could be some other things too, from pension plans if they have them, investments that have gone up and so forth. So the equity amount is 141, almost 142 billion. So then we see at the bottom, their total liabilities and equity is the same number as their assets, 333,779. So let's bring this together. And there's the retained earnings we'll talk about in the next video. All right. There's the equation we went over earlier. Microsoft had assets of 333,779 million. They had liabilities, total liabilities of 191,791. Stockholders' equity of 141,988. All right. What we do in finance is we look at how much money does Microsoft have sitting in current assets at the end of the fiscal year? They had 184 plus billion. What are they going to have to pay out in current liabilities during the next year? 88.6 or 7 rounded up. And that happens to be a very good current liquidity ratio. When you divide the 88.6 into the 184.4, you get 2.08. That's our current ratio. What does it mean? It means Microsoft has $2.08 that could come in the next 12 months to every dollar going out. The benchmark we like is a 1-to-1, and they are double that, over double. So they are very liquid. You don't have to worry about them paying their bills. They've got great liquidity, and that's what we want in a great company. The next thing we look at is their leverage or debt to equity. That's a very important leverage ratio. And we looked at their debt to equity, it's 1.35. What does that mean? Well, they had 191.8 in total liabilities. Their equity was 142 rounded up. It's close to a 1-to-1, but it's more liabilities than equity. So they're carrying a little more debt than equity. But still, that's very good. We'd like to see it to 1-to-1. They're 1.35 to 1. So they got $1.35 in liabilities to every dollar in equity. This happens to be a very strong balance sheet. And that's what the CFO and the CEO love to get up and say. We have a strong balance sheet, good assets, not too many liabilities, good liquidity, good leverage ratio. And that's part of their AAA credit rating. You know, there's only 2 companies in the United States with that AAA from Standard & Poor's, and Microsoft is one of them, Johnson & Johnson's the other. All right, we will move on to the retained earnings and the cash flow in the next video.